All right, welcome to the Explainer. Today, we're not just looking at a chart, we're launching an investigation. We're digging into a stock that is in a truly catastrophic freefall, and our mission is to follow the evidence and understand how a company's value can get so completely wiped out.
So, this is where it all started. Not that long ago, PAVS was trading at its 52-week high of $1.50. This was the peak, right? A price that represented confidence, potential. Remember that number, because, well, it's about to feel like ancient history.
And this is where we are today. Yeah, just over 3 cents. That's not a dip, it's a near total wipeout. We're talking about almost 98% of its peak value just gone.
So the big question is, how on earth does this happen? How does a stock fall this far, this fast? And is there anything left at the bottom, or is it just more falling? We're going to sift through the technical data, treat it like forensic evidence, and see what story it tells. Okay, let's get into it. And like any good investigation, first, we've got to establish the crime scene. We need to define the environment here to really grasp the forces we're dealing with.
And right off the bat, the evidence is screaming one thing. This isn't just a bad week. This stock is in a full-blown, severe bear market. And that's not just jargon. It's a technical term for a really deep, prolonged downturn.
And look at this. This really puts the scale of it into perspective, right? The price right now is about 3 cents, but the average price over the last 200 days, almost $1. That huge gap, that chasm, tells you just how brutal and relentless this collapse has been.
Okay, so we've got the scene. Now let's follow our first set of clues. We're going to follow the money. By looking at the trading volume, we can see not just what the price is doing, but where the cash is actually flowing.
So check this out, because what's cool here is how these two different clues tell the exact same story. First, you've got the OBV, or on-balance volume. Think of it like a running score between buyers and sellers. And right now, that score is absolutely tanking. It's just intense, non-stop selling. Then you have the ADOSC indicator. This one tracks the big money, the institutional players. And guess what? It confirms they are heading for the exits big time. The takeaway is crystal clear. Sellers are in complete and total control.
But here's where it gets really interesting. This might be one of the most critical clues yet. While the price is cratering, the amount of trading is actually spiking, up over 65%. Now you might think, hey, more trading, that's good, right? No, not in this situation.
This is what the pros call panic volume. This isn't excitement, this is a stampede for the exits. This huge surge in activity isn't new buyers jumping in, it's everyone who's still holding on, trying to get out at any price. It's a classic sign that we might be heading for a final, desperate capitulation. Okay, so let's recap. We know the sellers are running the show, we know they're in a panic. So let's look at our next set of clues, because this is where we get a sense of the raw power behind this downward spiral. We're talking about momentum.
I mean, when something's in free fall, the big question is always, how fast is it going? Is it starting to slow down, or is it actually picking up speed on its way to hitting the ground?
And wow, the signals are all pointing in the exact same direction. The RSI, it's getting close to oversold, but it's not quite there yet, meaning it still has room to fall. The MACD, that's just a straight-up confirmation of strong bearish momentum. But here's the kicker, the TRIX indicator. This one shows that the downward momentum is actually accelerating. Think about that. It's not just falling, it's falling faster.
But buried deep in all this data is this one single number. This could be our smoking gun. It's a reading from an indicator called the stock RSI, and a reading of absolute zero, well, that's incredibly rare, and it's incredibly important.
What this tells us is that we're seeing a signal of maximum short-term exhaustion. Okay, here's the analogy. Picture a sprinter running downhill as fast as they can. They're still moving, sure, but they are completely out of gas. Their lungs are burning. That's what this signal suggests. The stock's downward sprint has been so intense, it might be forced to just stop and catch its breath, even if it's just for a second.
All right, let's move on to our next exhibit. This one comes from the world of pure statistics, and it shows just how unhinged this stock's prices become from any kind of reality.
So get this, a statistical model, one that just looks at the stock's own recent history, predicts the price should be somewhere around 45 cents. But where is it actually trading? Just over 3 cents. The gap between what the math says should be happening and what's actually happening is it's mind-boggling. Let's put a number on that disconnect. The price is trading almost 93% below
where a simple statistical model says it should be. This isn't just an outlier, folks. This is the kind of event that breaks the model entirely.
The analysis calls it what it is, an extreme statistical anomaly. The price is totally detached from its own statistical average. And this really only points to two possibilities. Either all its past history is now completely meaningless, or a violent snapback rally to fix this insane imbalance is basically, mathematically, overdue.
So let's put it all together. We've reviewed all the evidence, the panic selling, the accelerating momentum, that critical exhaustion signal, and this wild statistical anomaly. Our investigation now points us to two very different but equally possible endgames for this whole situation.
And everything is going to be decided right here, between these key price levels. You've got the floor, the critical support, down at 2.7 cents. The immediate ceiling, or resistance, is at 3.5 cents. And the wild card in all this? The volatility is so insane that the stock's average daily move is 5 times bigger than its actual price. Just think about that.
So this brings us to the two potential outcomes. On one hand, you have scenario 1, the dead cat bounce. Remember that exhaustion signal? That could trigger a sharp, violent rally, just because the selling has finally run out of steam. But then there's scenario 2, the final capitulation. If that support level at 2.7 cents breaks, well, that could trigger the last wave of panic selling, driving the price down to its absolute final lows.
And that's where our investigation leaves us. Not really with an answer, but with a huge question. All the evidence from the money flow and the momentum, it's all pointing to absolute disaster. But the math, the stats, the exhaustion signals, they suggest a bounce is almost inevitable. So it all comes down to this. When you're standing at the edge of a cliff like this, is there really a difference between a calculated risk and just a pure gamble? I guess the market will have to be the one to answer that.